I'm a forensic equity analyst from Optivest. My entire job is to protect retail shareholders like you by cutting through the market noise and getting straight to the facts. Today, we're putting Colombo Dockyard under the microscope. We need to figure out if its incredible recent jump in value is a sign of a brilliant strategic move, or if it's a carefully laid trap for the everyday investor. And just so we're clear, our investigation is 100% objective. We're not talking about rumors or opinions here. Every single number and conclusion you're about to see comes directly from the company's own official reports. Think of this as a forensic examination. We're only looking at the hard evidence the company itself has put on the record. So here's how we're going to break this all down. We'll start with the company's incredibly volatile past, then we'll dissect the market hype that pushed the stock into the stratosphere. We'll uncover the truth about where the profits and losses really come from, look at global politics, and finally, put the popular story to the numbers test. That way, you can reach your own informed verdict. All right, let's dive in. To really understand the hype happening right now, we first need to hit rewind. Our investigation kicks off with a hard look at a decade of wild financial swings, just to establish what reality has actually looked like for Colombo Dockyard.
You know, the company's history is just a textbook case of volatility. It started 2014 looking pretty stable, but boom, the 2015 oil crash sent it spiraling into a book loss. The next few years were all over the place. And even after a little comeback in 2022, we see the biggest red flag of all in 2023, a total disconnect between revenue and profit, where making more money actually led to losing more money.
And I want you to really look at the scale of this paradox. It's shocking. In 2023, revenue hit a record 33 billion rupees. But instead of record profits, the company posted its worst loss ever, 11 billion rupees. This absolutely crushed the earnings per share, sending it from a positive 7 rupees to a catastrophic negative 153. This isn't just a tough year. This points to a fundamental breakdown in the business. So here's the million-dollar question, right? How does a company with such deeply troubling financials suddenly become the talk of the town, the hottest stock around? Let's dissect the anatomy of this hype and see exactly how market sentiment just completely broke away from the reality of the numbers we just saw. The story really built up in 3 stages. First, there was just general pessimism. After Sri Lanka's debt default, confidence was in the gutter. Then came the spark of speculation, when the Indian defense giant MDL started sniffing around. And finally, you get acceleration, where the whole story changed. The company wasn't a struggling industrial firm anymore. It was suddenly being talked about as a priceless strategic asset. And this number right here, this shows you the incredible power of that narrative shift. The share price just exploded, hitting a mind-boggling high of 480 rupees in 2025. This price had absolutely nothing to do with the company's performance. It was driven entirely by pure, uncut market euphoria. So here's where it gets really crazy. By the end of 2025, the stock was trading at 4.5 times its book value, the actual physical worth of its assets. Just let that sink in. You're paying over 4 times what the company is actually worth. And get this was all happening while the company was literally on the stock exchange's watch list because of serious doubts about whether it could even stay in business. So why on earth would anyone pay that price? Well, there are 2 powerful forces at work here. First is the scarcity premium. It's the only game in town if you want to invest in a major maritime firm on the exchange. But the second, and much bigger driver, is something called optionality. Investors weren't paying for today's profits, which, remember, are negative. They were paying for a story, for the option of landing massive Indian defense contracts someday in the future. Okay, let's peel back another layer of the onion here. It's time to separate the story from the reality and find out where Colombo Dockyard is actually making money, and more importantly, where it is just burning through cash. Now, when you look at the revenue breakdown for 2024, everything seems pretty reasonable, right? Ship repair is the biggest piece of the pie at 60%. But, and this is a huge but, this chart is dangerously misleading. Why? Because revenue is not the same thing as profit. And here it is. This is the core of the illusion. The ship repair business is the company's lifeboat. It actually makes a profit, and it's what's keeping the whole operation afloat. But the shipbuilding division, that's a massive anchor. It lost 3.6 billion rupees in 2024, right after losing a jaw-dropping 12.8 billion the year before. One part of this business is being systematically sunk by the other. And you might ask, why are these losses so bad? Well, it wasn't just bad luck. It was a direct result of a flawed strategy. The company deliberately took on shipbuilding projects at dangerously low prices, basically just to get a foot in the door in Europe. It was a high-stakes gamble that has clearly, painfully backfired. All right, now let's zoom out from the company's books and look at the world map. There's a major geopolitical crisis playing out that has become a real double-edged sword for the company, creating a surprising opportunity and a massive threat at the same time. We've all seen the news about the crisis in the Red Sea. When attacks caused shipping traffic through the Suez Canal to just plummet, ships were forced to take the long way around Africa. And guess what? This unexpected detour brought a huge wave of ships and their repair needs right to Colombo's doorstep. So this creates a really stark contrast. The opportunity is in these quick, high-margin repairs. But here's the massive risk. That same global instability has caused the cost of materials like steel and energy to skyrocket. And for that struggling shipbuilding division, which is already locked into fixed-price contracts, these rising costs are turning tiny profits into enormous losses. The crisis helps the lifeboat, but it's flooding the anchor. And now we get to the final showdown. This is where the rubber meets the road. It's time to put the exciting story that everyone is telling directly up against the cold, hard numbers from the company's own financial statements. On one side, you've got the narrative. MDL is a powerhouse from India, this is a strategic growth investment, and all this new capital is going to fuel a huge expansion. Sounds amazing, right? But then you look at the other side, the numbers. A working capital deficit of almost 13 billion rupees. Total debt over 26 billion. And that big capital infusion? It's not for growth. It's to settle existing debt. The story and the reality could not be further apart. And let's be absolutely crystal clear on this point. That huge 12.9 billion rupee capital injection from the rights issue? It is not a war chest for expansion. It's a bailout. It is being used to pay down a mountain of debt that was already there. This is a rescue mission, not a growth story. And that's a critical detail the market hype just conveniently seems to ignore. So, we've now examined all the evidence. We've reviewed the financials, we've dissected the hype, and we've put the narrative to the test. The final verdict, well, that rests with you, the investor. But to make a good judgment, you have to be asking the right questions. First things first, think about the buyer's real motivation. Is this acquisition purely about financial returns, about making the most money for shareholders? Or is it a strategic, geopolitical move by India to secure a critical foothold in the Indian Ocean, a situation where your profit as a retail investor might not be the #1 priority? And this all leads us to the ultimate question. Is this inflated stock price based on a real, believable plan for a turnaround? Or is this a classic case of the greater fool theory, where investors are buying an overvalued asset simply because they hope they can sell it to someone even more caught up in the hype for an even higher price? Before you go, 3 final thoughts. First, be careful with automated analysis. An AI can scrape numbers, sure, but it often misses the crucial fine print, like that watch list status, or the fact that banks are still demanding 100% cash deposits for guarantees, which is a huge sign of financial distress. Second, this analysis is for your education only. I have no vested interest in this stock. And finally, if you found this breakdown valuable, please share it. Empowering our fellow retail investors with hard facts is the best defense we have against market hype.